At some point, every real estate investor is going to sell a rental property. And when that day comes, your tax bill is going to be more complicated than you think. Because it's not just capital gains. There's also something called depreciation recapture. And if you've been taking depreciation deductions on that property, which you should have been, the IRS is going to want some of that back when you sell. Most investors don't find this out until it's too late. And sometimes the options can become limited. I'm Ryan Carrier. I'm a CPA who works with high-income earners who want to use real estate tax strategies to cut their tax bill. And in this video, I'm going to walk you through how to calculate your taxable gain when you sell a property so you know what's coming and how the math works and what you can potentially do to help you minimize the tax implications. So the first thing you need to know is that when you sell a rental property, your taxable gain is not simply your sale price minus your purchase price. That's usually how it works with your personal residence, but that's not how it works with a rental property. With a rental property, you have to account for something called adjusted cost basis. And that number is almost always a lot lower than what you originally paid for it because of depreciation, which means your taxable gain is almost always higher than what you expect. So let's run through an example of how this could look. Let's assume that you bought a $800,000 rental property. Say you have $10,000 of closing costs. Your total cost is going to be $810,000. And that's just the original purchase price, and that's your starting place. But then let's say that you add some improvements over the course of a few years, and you've made $40,000 of improvements, and now your total cost basis is at $850,000. Then we're gonna subtract all of the depreciation that you've taken over the years. Let's say that you have held this property for 5 years, you performed a cost segregation study initially, and you have taken $275,000 of depreciation. Because you used a cost segregation study, the amount of depreciation is really significant. So now you have an adjusted basis of $850,000 minus your $275,000 is going to get you to $575,000 of adjusted cost basis. Now, one quick important thing to note here is that even though you may be in a different situation where you did not claim depreciation, there's a difference in what the IRS is going to expect, which is the whole idea of what depreciation was allowed versus allowable. And that catches a lot of people off guard that you might think, oh, well, if I don't want to have depreciation recapture because I'm going to sell this in a couple of years, if this were to ever be scrutinized, the IRS is going to impute and say you were allowed or allowable to take depreciation, and they will calculate that on your behalf, even if you never took the deduction along the way. So please just be careful with that. Now, what I'm about to walk you through next is usually where people's eyes start to glaze over, but it's also where the biggest surprises show up on your tax bill. This is exactly the kind of planning I do with my clients at Carrier Tax Consulting. We don't want to just help you save taxes when you own the property. We also want to make some plans for when you sell the property too. If you're looking for ongoing tax planning and considering selling a rental property, and you want to know what the tax implications are as you consider selling a property, the link to book a call is going to be in the description. All right, let's keep going. So now you've got your adjusted cost basis of $575,000. The next step is actually calculating your taxable gain. That's going to be your sale price minus the adjusted cost basis. Simple enough, right? But here's where it can get a little bit tricky. The total gain is not taxed all the same. It gets split into two primary buckets. One is capital gains. Think of that as the appreciation of the home. And then depreciation recapture. That's recapturing the depreciation we just talked about. And each of those have their own separate tax rates. So let's say that you're going to sell this property for $1 million. And let's say at closing, you're responsible as the seller for $25,000 in closing costs. Your net sale price is now $975,000. Subtract that from your adjusted cost basis of $575,000, and your total gain is $400,000. Now again, we're going to split that $400,000 into two different buckets. One is depreciation recapture, and that's going to be the amount that we took for depreciation over the course of those 5 years, which in our example is $275,000. Now, because there was a cost segregation study, we have 5-year property, 15-year property, and 39-year property, assuming something like a short-term rental. Each of those different asset lives is going to have a different tax rate, but I've covered that in a separate video talking about real estate depreciation explained. So I'm not going to walk through all the details there, but just know in general that's going to have a higher tax rate than the capital gains, which we're going to get into next. So we have the $400,000 total gain, subtract out our depreciation recapture of our $275,000, and we're left with $125,000 of capital gains. This is typically going to be taxed at 15% or 20% for very high income earners, and you have the net investment income tax of the additional 3.8% tax. So all in, you could be looking at 18.8 or 23.8% tax. And that's just federal. You might have state on top of that as well. So to keep this simple, your capital gain portion could be as much as $23,500, and your depreciation recapture could be something like $85,000. Add them together and you've got a total tax bill of $108,500. The more depreciation you've taken over the time that you've held the property, especially with a cost segregation study, the larger that recapture portion is going to be as a percentage most likely. And this doesn't mean a cost segregation study is bad. It means you need to make a plan for the exit, not just the deductions. All right, so now you've seen the full calculation and you're probably thinking, okay, Ron, that's a big tax bill, but what can I do about that? The good news is there are some strategies to reduce this or defer this. And I'm only going to cover the ones that I see most commonly used with my clients, although there are others. The key is that you need to make a plan before you actually get under contract to sell this property. So number one is going to be a 1031 exchange. This is going to allow you to defer both the capital gains and the depreciation recapture as long as you reinvest all proceeds and follow the rules of this correctly. Now, the main rules are that you have to identify property within 45 days from the date of your sale. And you also need to have closed on a property that you've identified in that list within 180 days from your original closing date from your sale. And it has to be a like-kind real estate property. This is specifically a deferral strategy, not an elimination strategy, but it lets you keep your capital working instead of paying tax to the IRS. This works really well when you have a large gain, you want to continue to hold real estate, and you'll plan to buy a property at a similar price from your sale price. The second main one I see is a 1031 Lite. Similar to a 1031 exchange, you're going to sell and buy a new property. But this one's different because you're going to sell the property, not use a qualified intermediary like you would with a 1031 exchange, and you're going to fully recognize the full gain, the capital gain, and the depreciation recapture. But simultaneously in the same tax year, you're going to acquire that new property and you're going to perform a cost segregation study to generate a loss to then offset some of the gain, if not all or more, that you have on recognizing the sale of the property you sold. No 45 days to identify, no 180 days to close, but you do have to do this in the same tax year. That's a very important note that I want to make. This works really well with now having 100% bonus depreciation back. And if you're selling a property towards the first part of the year, because now you have more than 180 days to figure out what property you're going to acquire next. But there's no certainty that the new depreciation you get is going to fully offset or defer, if you want to see it that way, the gain that you're recognizing. So the time to plan for this is when you still own the property, obviously not after. A proactive tax strategist should be thinking about your strategy and your exit from day one. Look, so as you've kind of seen, selling a property is not usually as simple as sale price minus what you bought it for. There's the adjusted cost basis, and then you have depreciation recapture, and even within the depreciation recapture, you have different tax rates. And if you don't plan for it, the tax bill can significantly wipe out a huge chunk of what you thought you were going to make on this deal. If you want to understand how depreciation works more and why it matters so much, go watch my video on real estate depreciation, where I break it down a lot more for you from top to bottom. And I'll link it right here in the screen, and I'll see you in that video.